Well, Siddarth Bhamre, research head of Religare Broking, joins us. Hi, Siddarth. New avatar this time around. Normally we have got you to get your view on the markets and how you read the FNO action. So before we get to stocks, how are you reading the index first? We're at around 17,600. Your view on the index?
I thank you, Nigel. Nigel, we are not negative on this market, and various reasons have been pointed, but the key reason is that we are, commanding this great premium. If you look at, markets around, there's such a gloom and doom scenario, be it U.S. market, European, or even Chinese market, where there is a burst in housing bubble. And here we are talking about growth in housing space, infra space. We are seeing, inflows. Yes, there is some sort of confusion among foreign participants whether to buy or sell, and that can be seen on the data on regular basis. But in larger scheme of things, when we look back, say after a year or two, we will say that this 1 year, that is from October 2021 till date, it has been more of a consolidation in our markets when globally all other markets were correcting. So we are not negative. Yes, interest rates are rising across the globe, which would impact interest rate sensitive sectors. But overall, we are in a comfort space, and more allocation would happen towards India, which would keep this market, getting buying support at lower levels. So our recommendations and our advice to both from short as well as long-term perspective to our clients is not to be negative and hold on to your exposure in equity. Maybe there is a time for change in sectoral allocation after the significant run-up which we have seen, but one has to be invested in equity.
One has to be invested in equities. By the way, the USD INR future is already at 80, 85. Forget about 80, 81 is at risk. It's been that kind of a market. Siddarth, good afternoon. In terms of individual stock ideas, what would be any new idea that you've looked at?
Yeah. So, well, we are tracking more of ideas which are already tracked by market participants, but then Anuj, timing those ideas is of paramount importance. So, I have three stocks to discuss today. We are liking Dalmia Bharat Cement from cement space. We are also liking HCL Tech in IT. Though we are, our stance is that probably the underperformance of IT is more or less over. And I'll also talk on Metropolis, taking a contra call here compared to some of the market participants who have a sell recommendation. So let me start with Dalmia Bharat here. So yes, cement space is buzzing. Let's understand the fact that there is growth in housing space, infra space in our country, though others are still struggling. And what other factor which is fueling our sentiments to be positive on this space, and especially Dalmia Bharat, is that 25 to 30% of total cost is fuel cost, and now we are seeing pet coke prices, coal prices, fuel prices are coming down, which will aid this sector in an environment where the demand is quite vibrant. Even talks of Adani Group coming into this space would lead to a lot of competition. Mind you, there is a huge difference between a service industry and a manufacturing industry, and the kind of price wars which we see in service industry cannot be done in especially core manufacturing industry. So all these fears of Adani Group coming and spoiling the sector, I feel that is quite far-fetched. Coming to stock, I think this stock has been doing pretty well. It's fourth largest company. They have very aggressive plans. They are talking about tripling their capacity in next 8-9 years, and they're also planning to go green and have more of renewable power, which reduces and gives synergies in terms of operational efficiencies. Even if you look at valuation parameter wise, EV to EBITDA per se, the stock is trading at 8.4 times, and we have a target multiple of EV to EBITDA of 10. Which gives around 1950 as a target price for Dalmia Bharat. So we are suggesting Dalmia Bharat in cement space and avoiding frontline names. The other space is IT. Now this is again a controversial, Anuj. What we have seen is that IT, Nifty IT has corrected since Jan 2022, 31%. Nifty has corrected around 4 to 5%. So there is an underperformance of 26-27%.
Oopsie. So I think the ideas that were mentioned were Dalmia. You had HCL Tech, and Metropolis, all three of them. Sid, we lost you for a bit. You're back with us. Go ahead. Sid? Nope, I don't think that's... I don't think.
Yeah, can you hear me?
Yeah, no, you're back with us, Sid. Yeah, go ahead. You were making your point about the stocks.
Yeah, so I was talking about IT space, Nigel. There is a strong degree of underperformance which has happened. Now, my statistical observations, Manoj has been highlighting that how there is a possibility that the IT may stop underperforming. Now, it's very important to see we are not talking about absolute returns. We are talking about the underperformance getting over, say, in next 4-5% of correction in IT, which means that if Nifty corrects 5%, IT may also correct 5%, or eventually IT might start outperforming Nifty over a period of time. And we are talking here multi-year period. So maybe, more 4-5% down and IT would become quite attractive. SCL Tech is the name which I want to discuss here, Nigel. One of the cheapest name. We have SCL Tech and Infosys in our coverage. So I'll talk about SCL Tech. A growth of around, say 15% over FY23 and FY24 multiple, which we are assigning is around 14 times. It's a decent attractive buy with decent upside from current levels. So that is a contra buy. It's trading around 900. I would suggest buy on dips in HCL Tech maybe till 850, and it's an attractive buy from long-term perspective. And very quickly, I want to talk about Metropolis. I understand Street is not very optimistic in this space. But then the degrowth in last quarter or fall in margins is mainly because you have seen phenomenal rise in both the aspects in last 2 years, which were COVID driven. So expecting same kind of growth and margins to be when COVID subsides, I think that was too optimistic assumption by market participants. Even the concern of competition again foraying here is again too far-fetched, because if you look at the mix of revenue for Metropolis, 49% of revenues are coming from specialized checkups which are not price sensitive and are driven by only if someone has chronic disorders. So I believe market is pricing too much of negativity in this stock. It is already available at a price which was available at pre-pandemic. And you have seen almost 50% rise, 100% rise in profitability, 50-60% rise or 80% rise in top line. Even if you don't consider any growth in FY23 and a modest growth in 24, I think this stock is quite attractive at this point of time. And we are suggesting our clients to buy. We have aggressive target prices, but I think 1800, 1900 is on cards on this one.
Okay, all right, got that. Sid, hold on.